I recently had a good friend from college go through a divorce. He'd been married for over 30 years. He's in his early 60s and is successful, both professionally and financially. But he confided to me that his divorce has forced a reset of his retirement plans. Unfortunately, my friend's not alone. A recent study found that a staggering 36% of all divorces happen to people 50 and older. It's a phenomenon so common it even has a name: gray divorce. And the financial impact can be overwhelming. In fact, an Allianz Life study found that 56% of Americans say a divorce would derail their retirement strategy. I'm Mike Palmer, certified financial planner and founder of Ark Royal Wealth Management. Today, we're breaking down several of the most important financial considerations you need to be aware of if you're facing a gray divorce. Be sure to watch until the end, where we walk through some rather unique and challenging assets like deferred compensation and stock options that require special attention during divorce. Let's get started. In most divorce situations, the division of property is the main source of contention. In theory, each spouse receives 1/2 of each asset, as this is the most equitable division. However, in practice, this is rarely achievable because it can be impractical or impossible to divide each asset 50-50. Assets such as the family home or a closely held business are examples where an equitable division can be challenging. When dealing with assets like these, other assets are used in an effort to divide marital assets evenly. But here's what's most important for you to remember. Not all assets are equal. Let's take Bob and Mary, for example. Say Bob elects a $1 million taxable brokerage account and his wife Mary gets a $1 million traditional IRA. On the surface, it looks like a fair split, but it's not. The IRA is a tax-deferred account, meaning every dollar Mary takes out is taxed as ordinary income. Bob's brokerage account has already been funded with after-tax money, so only dividends, interest, and realized gains are taxed, and those are taxed at different rates. That makes the tax burden on the IRA far heavier. This is what we call an unequal division. For many couples, their home is the most valuable asset, and it often has great emotional attachment. During divorce, the question is, do you sell it, or does one spouse take the home as part of the property settlement agreement? If you sell your primary residence while you're married, under current tax law, you can exclude up to $500,000 of gain, provided it's been your primary residence at least 2 of the past 5 years. Conversely, the transfer of a home from joint ownership to one spouse doesn't create a new tax basis. If one spouse takes ownership of the home through the property settlement and later decides to sell, the capital gain exclusion is only $250,000. Next, let's talk about retirement accounts. In many households, retirement accounts are the largest financial asset. You must follow specific rules to split retirement accounts without triggering a massive tax bill. For a 401k or other employee-sponsored plans, you must use a specific document called a Qualified Domestic Relations Order, or QDRO. This is a court order that enables the non-participant spouse to receive a tax-free and penalty-free portion of the 401k assets. You can then roll that money into your own IRA or 401k. Now, if you're dividing an IRA, the rules are a bit different. An IRA is not an employer-sponsored plan, so you don't use a QDRO. An IRA transfer is handled through what's known as a transfer incident to divorce, which is outlined in your divorce decree. Provided the transfer goes directly from one IRA to the other, it will also be tax-free and penalty-free. It's important to remember that a 10% federal penalty usually applies to distributions from retirement accounts before age 59 and a half. So think carefully about your future cash flow needs. There are a couple of strategies that may allow individuals to tap retirement funds penalty-free prior to age 59 and a half, however. Finally, don't forget to update any beneficiary designations. As this Wall Street Journal article illustrates, it can be an expensive mistake with unintended consequences. Next, let's talk about spousal support or alimony. If one spouse has significantly more earnings or assets, the other spouse might be entitled to support payments. We also see spousal support used as an asset equalizer. As we mentioned previously, if marital property includes hard-to-value or illiquid assets, spousal support can be used to help balance the scales and create a fairer outcome for both parties. Under current tax law, alimony payments are non-deductible for the person paying them and are not considered taxable income for the person receiving them. This is a change from past tax laws, so it's important to get that detail right. While pensions aren't as common as they once were, a few folks do still have them. Because pensions are governed by ERISA, any pension benefits a person may have are subject to a QDRO as part of the property settlement. A QDRO can be drafted to award a former spouse a portion of a pension benefit, including a survivor benefit. Be sure the QDRO addresses a pre-retirement survivor annuity that spells out what happens to your benefit should your ex-spouse die prior to their retirement. It's important to coordinate the work of your divorce attorney with the pension plan administrator to make sure that all rules are followed and properly documented. When couples divorce, it's important to understand how Social Security benefits are impacted. Unlike other financial assets, Social Security benefits aren't considered marital property and can't be divided by a divorce court. Instead, the Social Security Administration has specific rules that outline how a divorced individual can claim benefits based on their ex-spouse's work record. To be eligible to receive benefits based on a former spouse's work record, you must meet the following criteria. Your marriage must have lasted at least 10 years. You must be at least 62 years old. You must be currently unmarried. If you remarry, you generally lose the ability to claim on a previous spouse's record. And finally, your ex-spouse doesn't need to have started receiving their benefit, but if they haven't, you must have been divorced for at least 2 years. As a divorced person, you can claim either your own benefit or half of your ex-spouse's full retirement age benefit, or FRA, whichever is greater. Remember, your benefits are reduced if you claim prior to your own FRA. So be sure to get expert guidance before making your Social Security claim. And if your ex-spouse dies before you claim Social Security benefits, you'll need to claim any of their benefits as survivor benefits. The claiming rules for survivor benefits are different from claiming the spousal benefit. We're almost done, so hang in there. If you have questions or comments, be sure to add your thoughts in the comment section below. And if you found this information helpful, be sure to hit that like button and subscribe for more personal financial tips. Now, there are also certain assets that can be more challenging to value and divide as part of a property settlement. Assets like annuities, deferred compensation plans, and equity compensation can be difficult to value due to they have vesting schedules and unique tax rules. Let's explore a few of these in a bit more detail. Annuities within an IRA can be problematic to split as part of a divorce settlement. The non-owner spouse must provide the insurer a copy of the court order and establish their own IRA for receiving their interest. Depending on state law, the insurer is usually required to provide a new annuity contract to this spouse with a new free look period. A free look period is a provision that allows you to cancel an annuity contract for a full refund without penalty, and this can help avoid expensive surrender charges. Fixed index annuities often have a cash surrender value that can be substantially different from the account value. So be sure the property settlement agreement stipulates which value is being used for the division of assets. In North Carolina, a new annuity purchase has a 10-day free look period, while an exchange or replacement annuity has a 30-day free look period. Most deferred compensation plans are non-qualified plans, and as such, they aren't governed by ERISA. The plan document stipulates how deferred comp assets are handled subject to divorce. Valuing deferred comp can be challenging because of constraints around changing distribution elections, their tax treatment, and how different tranches of deferred comp are invested. Equity compensation includes restricted stock units or RSUs and stock options. These assets are challenging because of fluctuating values, vesting schedules, and complex tax considerations based on when assets are sold and vested. My advice is simple. If your divorce involves any of these, don't go it alone. Seek professional guidance from an attorney working in partnership with a financial expert well-versed in divorce matters to ensure the division is truly equitable. Finally, when you divorce, your tax filing status will change, and that has a direct impact on your tax bill. Here's the key. If you're married as of the end of the year, you're treated as being married for the entire year. And if you're divorced as of the end of the year, you're considered single for the entire year. As a single filer, you'll pay tax at a higher rate and may lose the ability to benefit from itemized deductions that you claim when married. Dealing with divorce is never easy, but in a gray divorce, the financial stakes are higher. You have more assets to divide and less time to rebuild your net worth. That's why building a team of experienced professionals is so important. An experienced divorce attorney, a financial advisor who specializes in divorce issues, and a tax professional can help guide you through this process, relieve stress, and protect you from making an expensive mistake. Thanks for watching, and we'll see you next time. If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.